He was called the Big Bull of India. But no, he didn't charge at people in Dalal Street. This man turned a paltry sum of rupees 5,000 to more than 30,000 crore in the Indian stock market. And I can't even turn my Maggie into a decent meal. That's what one man did, without coding an app, running a business, or inheriting a fortune. He believed in just three things: India growth story, make informed decisions, and long-term investing. He predicted market crashes like weather forecasts, except he was actually right. This is the story of Rakesh Jhunjhunwala, the man who built a stock market empire and became India's Warren Buffett. Born in 1960, Rakesh grew up in a middle-class Rajasthani family in Mumbai. His father was an income tax officer, and money talk was common at the dinner table. But Rakesh, he wasn't just listening, he was absorbing. One day, he heard his dad say, "Stock markets react to news." Little Rakesh asked, "Why don't we predict the news and get rich?" His dad chuckled, "Son, we're government servants. Investing is for people who can take risks." And Rakesh took that personally. Fresh out of chartered accountancy, with 5,000 rupees and zero fear, he entered Dalal Street. At 13, he started reading balance sheets instead of comic books. In 1986, he spotted an opportunity. Tata Tea was trading at rupees 43 cents. He borrowed money and bought 5,000 shares. Within 3 months, the stock hit rupees 143 cents. His capital had tripled. Most people would cash out, but Rakesh saw something others didn't. The Indian economy was opening up, the markets were still a toddler, and he was just getting started. Over the next few decades, Rakesh Jhunjhunwala didn't just invest, he became a legend of Dalal Street. His most iconic bet was Titan Company. Back in the early 2000s, Titan was a struggling Tata Group company. The Indian retail market? Unconvincing. Most investors stayed away, but not Rakesh. While others doubted, Rakesh saw diamonds in the rough. He quietly scooped up shares worth crores.
And I thought Titan is well entrenched. Nobody could come into watch business. They are a very good marketing company. I thought branding business in jewelry will eventually succeed.
Betting on India's rising middle class, fashion sense, and trust in the Tata name. Today, that very stake is worth over 10,000 crore. He wasn't a gambler. He studied company fundamentals, macro trends, and most of all, human behavior. He bet big, but only when he was sure. For Rakesh, the single most important thing was opportunity size. Not where a company is today, but where it could go in 10 years. Opportunity size is the potential of the industry, the macroeconomic tailwind, the growth runway.
The first thing I look at is opportunity. Without opportunities, there can be no economic activity, and without economic activity, there can be no profitability. For example, when I look at Colgate, I look at the present demand for toothpaste in India and the potentiality for the growth in demand for toothpaste. Infosys became Infosys partly because what Infosys was, but Infosys also became Infosys because Infosys did not create the internet, or Infosys never foresaw the explosion in the use of information technology. But that was one of the key ingredients and reasons why Infosys, TCS, Wipro and other software companies were successful. Why? Because the opportunity just expanded.
He wasn't interested in a rupees 500 crore business that could grow to rupees 600 crore. He wanted a rupees 500 crore business that could explode into rupees 50,000 crore. Let's take an example. Rakesh bet big on Lupin and Aurobindo Pharma, not just because of margins, but because he saw global demand, aging Western populations, and India's cost-competitive edge. The market for generic medicine was huge, and Indian pharma could scale it. So when evaluating a company's opportunity size, Rakesh would ask, how big is the total addressable market, TAM? How much market share can this company capture in the next 10 years? Are there structural tailwinds? Structural tailwinds, refer to long-term, fundamental forces or trends that consistently support the growth of an industry. These are not short-term boosts, like temporary demand spikes or policy changes. Instead, they are deep, underlying shifts that create a favorable environment over time. Now let's discuss about some examples of structural tailwinds. Number one is digitalization. As more of the world moves online, companies in e-commerce, cloud computing, and cybersecurity enjoy structural tailwinds. Number two is shift to renewable energy. This creates long-term opportunities for solar, electric vehicles, etc. Rakesh Jhunjhunwala always looked under the hood. It wasn't just about how great a company looked from the outside. It was about how the business model actually worked. He asked one simple question: how does this business make money? And how will it make even more tomorrow? Because if that engine isn't working smoothly, if revenue doesn't convert into profits and cash, it's just noise. Rakesh was especially wary of business models that required burning cash to survive. If a company needed constant fundraising or kept posting losses quarter after quarter, he stayed away unless he saw a path to profitability. For business model analysis, Rakesh always broke down three things: revenue model. How is the company earning its revenues? Cost structure, fixed versus variable costs. Does the company have high margins? Cash conversion. Are profits turning into actual cash? If the answers didn't excite him, he moved on. Rakesh Jhunjhunwala looked at how a company was funded: debt, equity, retained earnings. He knew the mix mattered more than most people realized. Because in the stock market, leverage is a double-edged sword. It may amplify profits, but it can also destroy a company overnight. Rakesh looked closely at how the promoters raised capital. Did they issue equity to expand by diluting shareholders, or do they reinvest profits? Did they take on debt carelessly or negotiate it smartly? He loved businesses where the capital structure showed intelligence, not desperation. Capital allocation is something most retail investors miss. Just because a company is making money doesn't mean it's creating value for its shareholders. A company earns 100 crore in profit. What happens next? That 100 crore can go in many directions. New factory, buying another company, paying down debt, dividends to shareholders, or simply sitting idle in the bank. Which path it chooses? That's capital allocation. And Rakesh studied it like a hawk. Let's rewind to Titan, which was Rakesh's most profitable investment. Titan could have thrown money into unrelated businesses, but it didn't. It doubled down on jewelry, then watches, eyewear, and smart stores, all within the consumer luxury ecosystem. That's smart capital allocation. The returns weren't just financial, they were strategic. Rakesh loved businesses that reinvested profits into high-return projects, ones that earned more from every rupee they reinvested than what they paid out. Corporate governance is fundamentally about how companies are run. It includes the mechanisms through which companies, and particularly their boards of directors, are held accountable to shareholders.
I think that what is also very important is corporate governance. What kind of corporate governance? And I define corporate governance as how the company views all stakeholders, whether society, whether employees, whether shareholders, right?
Jhunjhunwala checked whether the promoter is trustworthy, or are they just a slick salesman with a mic. He would dig deep and find out whether the promoters are treating minority shareholder carefully. Have they ever siphoned company funds via related party transactions? The next lens was the board of directors. Jhunjhunwala believed the boardroom is like a cockpit. You need competent pilots, not yes men. He'd look at, are there independent directors? Do they have real power? Have they ever challenged the promoter's decisions? A board that just signs papers is dangerous. He wanted active watchdogs, people who think, question, and protect shareholder interests. Rakesh would never ignore them. A sudden auditor resignation, alarm bells. Frequent changes. He once said, if a company can fool the auditor, it can fool you too. Look out for auditors with reputable firms. Do they issue clean reports? Any footnotes in the audit report raising concerns? Jhunjhunwala loved it when promoters owned a large percentage of shares in the company. It meant they were not just running the company. They were emotionally and financially invested in its future. If the promoter held less than 30% stake in the company, he'd get cautious. If their stake was going down quarter after quarter, he'd ask, "Why are you selling shares if this is the golden goose?" Rakesh was more than an investor. He was a businessman and a film producer. He backed Akasa Air, saying, "Why should only Ratan Tata have an airline?" People called it madness. He called it entrepreneurship. He had a love for cinema, storytelling, and India's vibrant culture. So he backed movies like English Vinglish and Shamatab. Not blockbusters for the masses, but stories with heart, with soul. Stories that reflect the India he deeply believed in. That's the kind of man Rakesh was. A visionary, a risk-taker, a believer. He didn't fit into a box. He was a trader, a tycoon, a showman, a family man.